Welcome to the deep dive. Today, our mission isn't to talk about, the latest viral trade war tweet or some market headline. We are going much deeper. We're plunging into the quiet revolution that's happening just beneath the surface of global finance. We're talking about the hidden battles being fought in settlement ledgers, in these bilateral trade agreements signed at 2 in the morning by technocrats you've never even heard of.
Exactly. And this stuff, it sounds technical, but it's probably the most critical discussion happening in finance today. We're looking at a fundamental shift that is reshaping the risk profile for every multinational company and every central bank on the planet.
And the core problem is it's actually pretty simple, right?
It is. The U.S. dollar's unquestioned dominance is shifting. And the system we have, the one designed way back in 1944.
Bretton Woods.
Right, at Bretton Woods, it's now become a dependency trap.
Okay, so let's unpack that. I think the best place to start is with that ultimate paradox, the Triffin dilemma.
It's fascinating because the economist, Robert Triffin, he warned us about this back in the 60s. Yeah. He said the same currency cannot successfully be a national currency and the global reserve currency. It just can't work long term. The world needs dollars to trade, so central banks, they have to hoard them. But when the U.S. Federal Reserve raises rates to fight inflation at home,
Which it has to do.
Capital rushes into the U.S., looking for that safety, that higher yield.
And that just sucks the oxygen out of the room for everyone else, doesn't it? It starves emerging markets of liquidity. It's not some conspiracy. It's just the mechanism of the system working perfectly, but in a way that creates, brutal math for everyone outside the U.S.
It is brutal math.
Yeah.
But the numbers, they really don't lie about the pain point, especially for you, the listener, if you're responsible for any kind of cross-border finance. If you just look at the 2024-2025 reality check, the USD appreciated 6.88% in real trade-weighted terms.
Okay, that sounds a bit abstract. What does a 6.88% appreciation actually mean on the ground?
It means chaos for anyone with dollar-denominated debt or imports. Look at what happened elsewhere. The Mexican peso, it collapsed 16%.
16%?
The Brazilian real was down nearly 20%, and the broad emerging market currency index, it fell 9%. Now, picture being the CFO of a mid-sized South African manufacturer. You're importing components. You're operating on a thin margin, maybe 8%.
Right, and if you're getting hit by a 15% currency swing, and that's not uncommon, that one movement can wipe out your entire year's profit, your whole EBITDA just gone in a single quarter. You are completely trapped by currency risk.
And that trap, which was already, painful just because of the economics, it became absolutely existential when politics entered the picture.
And this is where it gets really, really consequential. We're talking about that geopolitical layer, the weaponization of finance. We all remember that unprecedented move in 2022 against Russia. The West froze central bank assets, cut access to SWIFT.
And the message that every central bank on the globe received was chilling. It was, your financial sovereignty is conditional. Every single institution responsible for national stability, they all drew the same conclusion, instantly. Dependence on dollar-based settlement systems is a threat to national survival itself. It wasn't about moral alignment. It was pure self-preservation.
And the data immediately backed up this fear. We saw financial fragmentation just accelerate. Central banks started strategically selling off U.S. treasuries, what was supposed to be the ultimate safe asset, and gold accumulation hit a 50-year high. They needed a defensive strategy, but the old playbook they'd been taught, it was completely broken.
Yeah, that old playbook had 3 main defensive strategies. Yeah. And all of them now, they pretty much amount to economic self-harm. First, you've got the brute force rate hike. The old textbook answer is simple. Just raise your domestic interest rates, raise them dramatically, and attract capital back home.
But that misses the point, right? The textbook assumes the outflow is because of your domestic policy, not because the U.S. Fed is the 800-pound gorilla.
It absolutely misses the point, and the cost is disastrous. Look at Turkey in 2022. They were forced to hike rates aggressively, from 8% to 24%? Their economy was destroyed. Inflation exploded, and the currency still collapsed again after a brief rally because the fundamental reasons for capital flight were still there. We know the cost. A 10 basis point rate increase, it equals a 0.5 to 1% penalty on GDP growth. You're delaying every major project, every job initiative for a year just to defend the currency.
So, okay, what's the second strategy? The last resort nuke.
Capital controls.
Yeah.
Just banning or severely restricting money from leaving the country.
Which is basically admitting defeat.
You're signaling to every foreign investor very loudly, we don't trust our own currency. Argentina froze bank accounts in 2001. Venezuela, well, we know what happened there. The result is immediate. Foreign direct investment dries up, and you breed this two-tier corrupt black market for finance.
And that leaves the third failed strategy, reserve depletion. This is where you just intervene directly. You sell your USD reserves to buy your local currency and pop up the price. We saw India do this in 2024 to stabilize the rupee.
It feels like the responsible thing to do in the moment, but the math is just unsustainable. If a central bank is forced to sell, say, $5 to $10 billion a quarter, those reserves evaporate in 1 or 2 years. It's like emptying your entire emergency savings account to pay a monthly utility bill. Just look at Sri Lanka in 2022. Once the reserves are gone, you are completely defenseless.
So if the old tools are just different forms of self-harm, the world needed a new playbook. And this brings us to what we're calling the IR4X framework, the new architecture. And the strategy here is critical, isn't it? It's not about fighting the dollar. It's about creating optionality, building bridges, not walls.
Precisely. This framework has 4 pillars that countries are using to win. Pillar 1 is strategic treasury rebalancing. This is sophisticated liquidity management. The core insight is to sell off the less liquid, long-duration U.S. Treasury bonds and hold more USD, but as pure cash.
So you're giving up that little bit of extra yield from the bonds for pure flexibility. It's a trade-off. Stability for liquidity.
It is. That cash is your dry powder. It's ready for immediate injection during a shock through these pre-arranged swap windows. It signals confidence to the market without needing to hike rates and destroy your domestic economy.
The India case study on this is perfect. In late 2025, the RBI, their central bank, they reduced holdings of longer duration treasuries and built up that USD buffer. So when the rupee came under pressure, they injected over $5 billion into the non-deliverable forwards market.
And just to clarify for everyone listening, NDFs, non-deliverable forwards, they're complex currency contracts to manage future exchange rate risk. By injecting liquidity there, the RBI managed expectations, they stabilized the currency without hiking rates, and India kept its 6% growth target. That's successful structural repositioning.
Okay, let's move to Pillar 2, multi-rail payment systems. This is about getting beyond SWIFT.
Right. The goal is to make the dollar optional for routine trade. And the crucial project here is called mBridge.
mBridge.
It's essentially a shared digital ledger, an infrastructure for instant peer-to-peer central bank digital currency exchange. And the metrics are just astounding. It reduces cross-border settlement time from 2 or 3 days down to 7 seconds.
7 seconds. And the cost is what, 50% lower than the old correspondent banking system?
50% lower. So if you can settle a massive trade, say between Singapore and Dubai, without ever touching SWIFT or converting to the dollar, you've achieved true optionality. And it's happening now, along with other rails like China's CIPS.
Which brings us to Pillar 3, local currency trade, or LCT. This is about getting rid of that massive hidden tax on global trade.
Explain that tax.
So in the old system, an Indian rice exporter sells to a Brazilian coffee importer. The Indian exporter gets paid in dollars, then has to convert to rupees. They lose, what, maybe 2% in that transaction?
At least. Then the Brazilian importer has to convert their reals into dollars, and they lose another 2%.
So that's a 4% conversion tax on the whole transaction. That just vanishes into the financial system.
It's a huge inefficiency. With direct LCT, there is no conversion tax.
Yeah.
For a moderate $10 billion in trade between two countries, that's $400 million that stays in their local economies. India made a huge breakthrough on this in 2025 by establishing direct reference rates like INR to the UAE dirham, without the dollar as the middleman.
That sounds like great financial optimization. But let me push back a bit. Isn't LCT just a fancier name for trade protectionism? Doesn't this system create massive complexity for small businesses who now have to manage a dozen currencies instead of just the dollar?
That's a fair question, and it absolutely adds complexity. But that is where Pillar 4 comes in. The core driver here is cost reduction and efficiency, not protectionism, and that risk, the risk of complexity, is being mitigated by technology.
Okay, Pillar 4, algorithmic hedging for CFOs. This is where AI and machine learning step into the Treasury Department?
Exactly. AI-driven treasury systems are now monitoring real-time volatility across 30-plus currency pairs at the same time. So instead of the default choice always being the dollar, the algorithm is constantly recalculating where the volatility math works best for that specific transaction right now.
So a company might decide, okay, we'll invoice Japan and the UK in their local currency. But for our Indonesian client, the algorithm says invoice them in Japanese yen because the volatility profile and the interest rate differential make yen settlement cheaper and more predictable today.
Precisely. And the impact is significant. We're seeing companies that deploy this, their FX losses drop dramatically, often from 1.5% of revenue down to 0.3%. The technology is here, and adopting it is the new corporate defense.
Which leads us right into the corporate playbook. The mindset for a CFO has to fundamentally shift from we must use the dollar to we have options and we have to optimize them.
For exporters, the strategy is segmentation. You move from invoicing everything in USD to using local currencies with strategic partners like India or the UAE, where these LCT agreements are in place. By using dynamic invoicing platforms, companies are recovering 1 to 2% in FX spreads. I saw a case study of a software company in Bangalore. They saved $1.6 million annually just by optimizing their invoicing.
And for the big importers, the power dynamic has shifted even more. They now have leverage. Their negotiation has changed from what's the dollar price to asking suppliers, can I pay you in my currency? Or can we settle this over Enbridge to cut costs?
Absolutely. There's a Mumbai pharmaceutical company. They import $200 million of ingredients a year. They shifted a huge portion of their trade to Chinese yuan and LCT rails. They saved over $2 million a year in FX costs and, crucially, freed up working capital by cutting settlement delays from 3 days to 7 seconds.
So what about the central banker's final defense, the asymmetric move? It's all about repositioning the reserves to defend against that weaponization risk we talked about.
Right. The smart allocation in 2025 is moving away from that heavy reliance on treasuries. The new model, it looks more like, say, 35% in treasuries, but a big increase in gold, up to 25%, and a solid buffer of 10% in cash USD.
Why so much emphasis on gold?
Gold is the ultimate dry powder. It is sanction-proof, it's universally acceptable, and you can swap it for any currency in a true crisis. It offers instant liquidity with full sovereignty. The core defense is speed.
And structurally, we're seeing countries like India improve the actual use case for their currency. They're using something called Special Rupee Vostro accounts, or SRVAs.
Yes, SRVAs are basically accounts that let foreign banks hold and manage rupees. The Reserve Bank of India relaxed the rules, and they now allow foreign banks to invest their surplus rupees, the money they earned through trade in high-yielding Indian government bonds.
So you're creating a direct financial incentive. You let them earn a guaranteed 6+% yield on their extra rupees, so they actually want to hold rupees.
Now,
That increases liquidity and makes bilateral trade so much easier. That's clever.
it connects the technical financial architecture directly to the profit motive.
And if we look ahead to, say, 2026, 2027, this whole architecture just accelerates. We expect Enbridge to move from pilot to formal production. Volumes are going to increase tenfold, and you'll see crucial enterprise software, your SAPs, your Oracles, start adding built-in CBDC settlement connectors.
LCT will become standard operating procedure, not an experiment, especially across that fast-growing India-UAE trade corridor. But the real flashpoint, I think, will be geopolitical. It'll be the scenario where a regional power, say Brazil or India, gets sanctioned, and they just switch to Enbridge instantly and the sanctions fail to freeze their trade. That is the moment the dollar's transactional monopoly is proven to be broken.
So with all this change, what are the biggest pitfalls? What should you, the listener, be watching for? Because this isn't without risk.
There are 4 key risks. First is the CBDC trap. If the regulations get too complex or adoption stalls because of privacy concerns, the whole multi-rail project just fails to get off the ground. Second is geopolitical fragmentation. The world could just rigidly splinter into a USD bloc versus a non-USD bloc, forcing every company and country to make this agonizing choice.
Third would be an uncontrolled currency crash.
Yeah.
I mean, these new tools are great. They reduce the dependency trap, but they don't eliminate volatility if your fundamentals are bad. If a country has poor budget discipline, its currency will still crash, no matter how many payment rails it has.
And finally, the central bank trap. This is where central banks start accumulating massive trading losses by trying to actively manage their currency. If they miscalculate, they just erode their credibility, which is their most precious asset.
I think this all connects back to the philosophical shift. For 80 years, the answer to currency risk was use the dollar. It's inevitable. It's safe. Now the answer is you have options. The dollar is useful, but it's not mandatory, and the cost of not having options is just too high.
It's a fundamental redefinition of financial sovereignty. A central bank no longer has to choose between sacrificing its policy independence or sacrificing its economic growth with painful rate hikes. They can choose strategic positioning. They can choose multi-rail architecture. It isn't anti-dollar. It's just beyond single currency.
The closing truth here for you, the listener, is that this war isn't being fought by finance ministers giving speeches. It's being fought in thousands of tiny technical decisions. A CFO changing an invoicing strategy on a Tuesday afternoon. A central bank repositioning its reserves. An engineer building a new 7-second settlement system. It's a constant, relentless war of attrition.
And the lesson is clear. The prepared will thrive. The complacent, they become someone else's case study. The key is to bring currency strategy into your boardroom-level planning. You have to treat volatility as a core strategic risk, right up there with supply chain disruption or cyber risk.
Which means integrating advanced solutions, things like AI, virtual account management, geopolitical foresight, into your core financial structure today. That shift from reactive defense to proactive optionality, that is the only way to win in the multi-currency world of 2025 and beyond. So what strategy are you going to adopt first?